Welcome to Bloomberg Markets. I'm Sonali Basak. Traders getting relief today from the latest PCE data, which came in line with estimates. And it erases the fear of another disappointing inflation report, at least for now. Let's get a quick check on the markets here because the S&P is struggling here to stay in the green. We're up about 0.1% at the moment. The NASDAQ 100 seeing a little bit more love there, about 0.3% higher, a little more than that at the moment. The two-year yield has been an interesting place to watch after that inflation print today. We're standing at around 462, a move about 1 basis point lower. But you have to understand, we were at 460 a little earlier today. So you've seen moves of more than 10 basis points this week. We started the week above 470. Remember that. Bitcoin above 62,000. We are barreling towards record highs. Remember, we are only thousands of dollars away, and it has been quite parabolic. Now, some midday movers on the equity side here. We're looking at some good news and some bad news. Remember, we are still in earnings season. Snowflake is falling by the most ever after delivering a disappointing sales forecast. Also announcing that CEO Frank Slootman is stepping down from the role. More on that later this hour. We're also watching shares of Best Buy rising on an upbeat earnings outlook, now up more than 3.6% on the day. The company has been struggling with soft demand, though, for electronics. Hormel seeing the biggest intraday gain since May of 2000 after the meat producer reported its biggest earnings per share beat since at least 2013, and Bath & Body Works falling after disappointing sales and profit views in the current quarter, even as results from the holiday quarter beat estimates. And today's PCE data, remember the big news, showed inflation rose in January at the fastest pace in nearly a year, helping explain why the Fed has been so patient in its approach to interest rates. And earlier today, Wall Street Week's David Weston caught up with San Francisco Fed President Mary Daly. She spoke about the broader fight against inflation.
And the way monetary policy works is actually you raise the interest rate, and that raises borrowing costs, and that slows people's spending, and then the economy settles down to a more sustainable pace, and inflation comes down. That's how the models work. That's how it empirically works over time. What's different this time is that consumers have just stayed in the game. They continue to spend. They continue to want to participate in the economy, and that's spurred growth, ongoing growth, and that's kept inflation a little bit higher for longer than we would have thought. But I still think overall the news is good. And yes, we absolutely see the challenges that families face when they have to pay higher borrowing costs. But we also know that what they really want us to do is bring inflation down. There is no place I go. I have a very big district, 9 states, but you can travel anywhere in the United States, hear the same thing. What's your number one problem? Inflation. That's what people are focused on, and that's what our job is.
Now let's discuss the overall picture with Mithra, Warrier, Prime Origination, and North America Head of Capital Introduction at Citigroup. When you look at the macro environment, the expectation for interest rates just changing so drastically, how are hedge funds navigating this environment?
So one thing everybody agrees on is that this macroeconomic backdrop is uncertain. You've had some surprises all along. And actually, this is exciting for many of our clients because uncertain macroeconomic backdrops create two things: opportunities and dislocations. So on the opportunity side, it's all about paying closer attention to the numbers, paying attention to the fundamentals. And on the dislocation side, it's about risk management. Pay attention to your position sizing, look at correlations, be nimble. And so both the opportunities and the dislocations are actually things that create excitement among our client base. And one thing that's actually really refreshing is we don't have one view on how everyone's positioning. And so there's lots of opportunities for different ways of expressing sentiment on the macroeconomic view, and that creates opportunities for the market as a whole.
Well, it begs the question, too, when you're thinking about the macroeconomic view, you've had macro funds come into vogue in recent years, some of them with massive gains on their bets, some of them really struggling to make it through. Are you finding more interest when it comes to macro strategies this day or the regular way equity market?
So I would say from allocators of capital, there certainly remains interest in the macro strategies. Also, although we saw a tremendous amount of interest, I would say, in 2021 and 2022, that probably has come off the peak a little bit there, partially because 2023 was a tough year for macro funds. And so for macro funds, it's about demonstrating the opportunity to differentiate themselves from the pack, not crowd into the same trades, and the opportunity for sound risk management, not have 1 or 2 months or big drawdowns that bring down your whole return profile. So yes, they consistently remain of interest, but I would say off the peaks of what we saw in 2022.
You know, it's funny you mentioned crowded trades. How do you think about that as it pertains to the equity market? I had some interesting data shared with me from Citadel Securities just days ago about single names seeing crowded interest from retail traders. So what's the fast money doing?
I think there's a big concern about crowded trades. However, there's a lot more tools at our clients' disposal to monitor for crowding and to account for that as part of your risk management and your position sizing. That said, outside of the sectors that are dominating the headlines, we're also seeing our clients who are active in sectors like biotech, real estate, financials, other areas that maybe don't make the headlines as much. That's where they're finding alpha. So from the standpoint of our hedge funds, it's about where is the alpha and how do we think about crowded trades from the standpoint of alpha generation?
Well, it's funny because you had a NASDAQ 100 just soar past 50% last year. How are funds feeling this year about stock picking? Where are they finding that alpha?
I think funds are under pressure to generate alpha and not just produce returns that are beta. So alpha generation and stock picking is key. So it is in areas where maybe looking at short interest is an area. That's certainly something that a lot of our clients are focused on. Again, we talked about differentiated sectors and positioning the portfolio. Do you have a more diverse portfolio? Do you have a more concentrated portfolio? Is going bigger in certain names? Are privates an opportunity? So it really comes back to how can you have a repeatable process? How can you generate alpha beyond what anyone can just get from passive investing in the marketplace?
It's interesting, Mithra. How are people feeling about going short in this market? You look at some of the names that some of the big short sellers have targeted, and you see the parabolic rises that they've had in the last year. Are people a little afraid to bet against the herd?
I would say the skilled short sellers are actually finding opportunity in this space. There's no question that you have to pay attention to factors such as the retail investors and technical factors that can squeeze you out of your shorts. However, people who are looking at the fundamentals, looking at secular trends that they feel are going to persist for the long term, they are shorting. And we are continuing to see short sellers come into the marketplace for reasons that are based on their sound fundamental analysis.
What are some of those secular trends?
I think you are seeing industries that are not going to be relevant to the consumer. There was talk about the consumer before. Industries that are not going to be as relevant to the consumer. Industries that cannot innovate as easily. Industries that are going to be affected by possibly inflation that's higher for longer. So looking through those, and then it really comes down to company by company, name by name, and paying attention to the technicals also. What does your short borrow look like? What are the memes saying, et cetera, things that maybe you wouldn't have had to look at 10 years ago.
It's funny, people think that the meme traders are gone, but they are certainly under the surface these days. We're on a day where the Philadelphia Semiconductor Index is still up about 1.8% today. It's in the green, but you have seen a stalling out generally since those blowout NVIDIA results. How are funds feeling about the AI boom here? Under the surface, when I hear from them, some people feel like they're lucky sitting in the names. Some of them are nervous getting in at new highs. What are you hearing?
I think it comes down to what is the valuation as it relates to your long-term investment thesis. So for funds who have been, who view AI as part of a secular trend that is going to contribute to their alpha generation, they're in it. For funds who are maybe looking at the returns and saying, gee, I wish I had participated in this as a market gain, they're coming back to realizing that they're not getting paid for beta. And so it comes down to, again, your fundamental analysis, what your view is, how does this contribute to your overall investment thesis, and how are you generating outsized investment returns for your investors.
Now, how do you think about the multi-strat dynamic in this environment? It's kind of exciting to talk to you again about individual strategies because for so long those multi-strats have been sucking all the air out of the room. But are they as exciting in a year like this where the cost of leverage is higher?
Listen, multi-strats are now, I checked, I think about 20% of the overall hedge fund AUM. This compares to, if you look back 30 or even 20 years ago, multi-strats were less than 5% of hedge funds' asset under management. You cannot ignore them. They're here to stay. Some people think the assets and the fundraising in the multi-strats may have peaked. That may be true, but they continue to be highly relevant. And part of the reason they're relevant is that if you look over time, uncorrelated, consistent return stream multi-strats have generated and will continue to do so. You're also seeing capital looking for access to hedge funds coming from places like the Middle East, Asian family offices, and also let's talk about the rise of private wealth investors wanting access to alternatives. Multi-strats are a great option for them.
Well, it's interesting. You've seen some of the high-level talent spin out of these large multi-strats now launching their own funds. You think Bobby Jane out of Millennium not raising as much as initially hoped, but still one of the largest launches in years expected this year. Todd Barker out of Citadel as well. How much money is there really to put to new funds right now?
I think, as I mentioned before, the Middle East is an area where there is a lot of interest in allocating to hedge funds. We talked about family offices coming out of Asia, maybe looking away from China and looking to invest their capital in the United States. And then in the private wealth space and wealth management, you have an increased sophistication in investors that want to allocate capital. So maybe it's not droves of net new capital, but you still see strong interest in hedge funds and in the multi-strat space.
Mithra, there is still money to be raised this year. We appreciate your time. That is Mithra Warrior of Citigroup. Now, coming up next, a conversation on the deal market with one of the top names in the industry, Melissa Sawyer, global head of mergers and acquisitions at Sullivan and Cromwell, one of the top firms advising on some of this year's mega deals. Stick with us. That's next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. Activity in the M&A space is generating a lot of buzz so far in 2024 and getting the attention of Washington. Democrats want regulators to overhaul merger review procedures for banks to head off tie-ups, like Capital One's planned takeover of Discover, and lawmakers like Democratic Senator Maxine Waters writing in a letter this week, House Representative Maxine Waters. For far too long, these procedures have been equated by experts to be rubber stamping a process where virtually all applications are approved while industry consolidation continues. We strongly encourage your agencies to put away that rubber stamp and promptly finalize robust merger review procedures. And this stance could make deal-making more challenging for law firms across the country and investment banks alike. Now, Sullivan and Cromwell, which is ranked second when it comes to advising on deals over the past year, Melissa Sawyer is the firm's global head of mergers and acquisition and joins us now. Melissa, you've worked on some of the largest deals of the year so far. So when you look at the tone coming out of Washington, there is a lot of question about how much that wrangling will make a difference when it comes to the agency's review of these deals.
Yeah, there has been a lot of rhetoric that is anti-merger in Washington just in the last couple of years. I think there's a big gap between the rhetoric and the reality of deals getting approved, though. The rhetoric is coming out within 24 hours of deals being announced. We're seeing politicians like Elizabeth Warren make statements that deals should not be approved. We've seen the FTC and the DOJ promulgate new merger guidelines and tighten up the procedures for getting transactions approved, making the process more expensive and more cumbersome. But the reality looks a little different. If you look at the data of what has happened under this administration compared to prior administrations, actually the percentage of deals that are getting second requests, which are investigations or that are being blocked through litigation, actually isn't higher than it was under prior administrations.
Now, what does it mean for certain deals? Like, you think about Capital One and Discover, and something that struck me was that the deal announcement came after the OCC and the DOJ really came out with new guidelines on what to expect. What that tells me is these companies know what to expect. In some ways, do they have more clarity from the regulators on what's allowed and what's not?
Yeah, I think companies are much more sophisticated in how they're thinking about rolling out deals, and actually they anticipate this kind of negative reaction and plan for it. I think as deal makers, we're also spending more time in our negotiations allocating the risk of that sort of rhetoric and thinking about how the parties should react once that kind of public fervor comes out against the transaction, and what their obligations are to use efforts to get the deal cleared nonetheless, even if there is a negative reaction to the transaction initially.
There's also this aspect of just because the government sues, an agency sues, doesn't mean a deal isn't going to get done. So is there an aspect of this where the FTC might come forward and companies are ready to sue anyways?
Yeah, I mean, we have seen only about 50% of the FTC's litigation efforts bear fruit. So a lot of those deals are getting cleared or passing through anyway. I think that means that parties have to really buckle their seatbelts and be willing to be in it for the long haul. But time is the enemy of deals. So getting hung up in a lengthy antitrust process in some industries is a deal killer, which is why I think we're seeing a chilling effect because of all of this rhetoric, because of the long time period that it's taking to get deals approved.
How does that shape up for the pipeline? Are there certain deals that are being considered right now that just instill some fear in certain CEOs out there because they don't want to deal with Washington?
Yeah, there are a few areas I think that are particularly sensitive right now. One is just mega deals. By their sheer size, they tend to attract more attention, and the parties to those deals tend to be strategics. And they're parties that are more likely to have competitive overlaps. They're more likely to be in the same industry. They're more likely to be dominant players because they're so big, and they're more likely to be international.
How do you define mega deal these days? Is it above 10 billion? Is it above 20 billion?
For those, I would say 50 billion and greater. The other categories are sort of more sector specific. I think tech and healthcare have been areas that the regulators have been highly focused on. So companies that historically grew through acquisitions in those industries, I think now are having some real hesitation.
It seems like energy has been kind of immune from that dynamic. Why?
Yeah, to some degree it has been. I just think that the regulators haven't had the same interest in oil and gas acquisitions that they've had in, for example, the data privacy issues and other types of things that come along with tech.
So at the end of the day, if you are advising a client and you ask them to, lay out their consideration for deal making, what is the biggest concern you would have as their lawyer? Is it vertical versus horizontal deals? Is it the impact on the consumer? What is supposed to be their biggest concern when they're thinking about strategic moves?
It's very deal specific. So for example, right now we know that the agencies are highly focused on the impact that deals have in labor markets. They're looking at the individual impact on employees' ability to earn a wage, but they're also looking at the impact on unionization, which is a hot topic during an election year in particular. That's not relevant in every sector. Other sectors, they may be more focused on issues like data privacy. Like I said, we saw that in the Amazon iRobot situation. So I think it varies from case to case.
How do you think about private equity for a minute here? Because one thing I find interesting is that you have all this dry powder on the sidelines. They're waiting to deploy it, and they don't have the same competitive concerns per se. But the American public still has a feeling, a concern that if private equity takes over, what does it mean for jobs? Does private equity have the same concern when it comes to Washington at the end of the day, because they don't have to face as many antitrust issues?
So it used to be that when we ran sell-side processes, we would love to invite private equity bidders into the process because we assumed that they had no competition issues. That's actually not the case anymore. The agencies have been highly focused on private equity portfolios and looking at whether they have other portfolio companies that may have overlaps. So I think everybody is treading a little bit more lightly in the sphere of private equity and starting to look at the broader fund complex for potential competition issues, whereas that was never the case 10 years ago.
That's pretty fascinating when you think about how roll-up strategies have always been such a traditional way to go. Now, you kind of alluded to this interest from Washington around international buyers. Explain where the brunt of the problems are coming from. There are certainly specific areas that regulators and lawmakers in particular have been very concerned about.
Yeah, it actually goes in both directions too. So Washington is worried about it, but other countries are worried about investment from the United States. So just to give a couple of examples, Chinese investment in the United States is basically at a standstill right now, and that's because Washington has been hyper-focused on Chinese investment. Whereas in Europe, they recently adopted something called the European Subsidies Regulation, which is really looking at non-European investment into Europe by companies that have benefited from governmental subsidies in their home countries. So I think in every jurisdiction that you look at, you're seeing this heightened focus, this proliferation of regulatory regimes that extend the timeline to get deals cleared and make it harder to get them approved. So big deals that touch a lot of different countries now have to pass through this really extensive process to get cleared.
Certainly getting complicated out there, but to the point we've been making, just because you face scrutiny doesn't mean you can't get a deal done. Thank you so very much.
Said.
Melissa Sawyer of Sullivan and Cromwell, we should also say, named one of the top 10 lawyers in M&A in the world. Now, still ahead, we're going to talk more about deals and leverage finance, how the head of global credit finance at Goldman Sachs, Christina Minnis, is assessing risk in the deal market. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak, and it's time now for the Wall Street Beat. Goldman Sachs head of global credit finance, Christina Minnis, says she's seeing a wave of deal interest for the first half of 2024. Last night, I spoke with her as part of a Bloomberg New Voices event and asked her what she's watching in the deal market. Take a listen.
It's not surprising to me, but I always chuckle a bit when folks that maybe were born a few decades after me, look at this cost of capital and go, it's so expensive. It's expensive compared to a very unique period in history, but it's not on a historic basis.
It's interesting because even though you've seen M&A start to come back, big ticket deals, what you haven't really seen come back yet is the return of the large LBO.
It's starting. There was a deal, announced last week in the financial services industry, $15.5 billion, and the financing there is about $9 billion. Is it back to where it was, pre-Ukraine or no? But we're starting to see signs of, again, sizable transactions coming back to market. So I think it'll be gradual, but it's definitely coming back.
There's a question also of what stops the party. Is there anything, if it's not high interest rates, what would set investors off guard here? What would put them on edge?
I think investors have gotten very expecting of the soft landing that our Jan Hatzius has been calling for, I think correctly so, for a period of time. So I think it starts with the economy. I think if we started to see some nervous signs in the economy, both here in the U.S. as well as globally, that would concern us. But I also agree that the geopolitical situation in 24 is going to take center stage. Many of our clients have tried to move their transactions into the first and second quarter, which is one of the reasons why I think we've had such a robust first quarter, and I expect that to continue up until the summer. People are quite concerned about the fall.
That was Goldman Sachs head of global credit finance, Christina Minnis, speaking at Bloomberg New Voices here in New York City. Now let's have a quick check on the markets here too, because we are looking at an S&P that has been wavering on the day. We are now up about 0.1%. We were watching the Nasdaq gain some steam. The Nasdaq 100 up more than 0.4% on the day. It's interesting, this yield movement here. You did see a drop off in yields down to about 460 earlier today. You were back up to 463. Traders still digesting that inflation print, as well as thinking through those expectations for rate cuts, parsing through all the Fed speak this week. We're watching also the 10-year yield hanging out at around 4.23. Now coming up, Mike Novogratz joins the show to discuss the crypto rally, macro, and more. Stick with us. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. Let's get a check on the markets here with the S&P 500 breaking further into the green here, up about 0.1% on the day. It has been wavering. The Nasdaq 100 also gaining some steam here, up more than 0.3%, was up more than 0.4 at one point today. The two-year yield also losing the bid that it had. It's back to 4.63 on the day, barely changed, but we did see a little bit more of a bid earlier in the day. The 10-year yield down to 4.24 on the day, and some midday movers to talk about on the equity side here. C3AI shares surging by the most in 9 months after strong sales in the last quarter, suggesting that the company's bet on new artificial intelligence-based apps is paying off. And Paramount shares also rising after revenue in its streaming business beat expectations and projections that Paramount Plus should be profitable domestically next year. And in the crypto space, Coinbase still recovering from yesterday's influx of traffic during the recent Bitcoin rally, putting some users off in the middle of the day. And Bitcoin miner Marathon Digital plunging following an EPS beating earnings, but analysts noting how new accounting rules help boost those results. Marathon Digital down now more than 17%, almost 18% on the day. Now, the addition of spot Bitcoin ETFs is paying off for Bitcoin enthusiasts. Bitcoin nearing all-time highs after those ETFs widened the demand for the token, attracting more than $7 billion of net inflows in less than 2 months. And now we have Galaxy Digital founder and CEO Mike Novogratz joining me now. Mike, talk to us about what you're seeing under the surface. I think a lot of people are watching Bitcoin go absolutely parabolic and wonder what is exactly driving the flow. Who's driving it?
Well, listen, this is probably the first time in the history of Bitcoin that we have true price discovery. And what I mean by that is this is the first time that anyone who wants to buy it has easy access to buy it. And so, right, baby boomers have $85 trillion of wealth. Their wealth is, for the most part, managed through registered investment advisors who now, at least half of them or some portion of them, can just buy the ETF. And so you're seeing, a step function in new owners of Bitcoin, which is driving, I would say, a frenzy in the whole crypto ecosystem, right? So how crypto always works is Bitcoin gets bought and some people sell a little bit to buy Ethereum and they try to play the catch-ups and the altcoins. And I would say we've gotten to very frothy levels. You can see it in the funding rates of the altcoin market, how much you get paid to actually lend out your coins in Bitcoin, Ethereum, and all the alts. And so you saw it in the equities, the public equity markets, right? MicroStrategy, Marathon, all the kind of public equity bellwethers really went parabolic along with Bitcoin. And so I wouldn't be surprised to see some correction and some consolidation. But I'm very loath to pick a Bitcoin high because I really do believe this is price discovery. Will we test the old high? Most likely. And you'll probably have some consolidation. But I still think we're going to end the year much higher.
It's interesting to hear you kind of come in with some caution in the middle of this euphoria. It begs the question, what's also the new low?
We broke out from 45,000, and so that would probably be what should hold us if there's a real correction. You never know why corrections come. Something happens and people shift mindset, and there's a lot of people that have bought recently. I don't think it'll get there, quite frankly. I think if it corrects, it probably corrects to the mid-50s before taking off to the new high. First the old high, that's 68, 69,000, where we got pretty close. But I do think then you're going to see, and partly this is, if you look at Fidelity or any of these big platforms that have so much baby boomer wealth, just shifting 2 to 3%, 1 to 3% of those assets, encouraging their customers to shift to Bitcoin over time, which has been an amazing diversifier, is a monster number, right? You think about it, like I said, 85 trillion of baby boomer wealth, 3% of that is 2.5 trillion, right? The whole market cap of Bitcoin is only a little more than 1.2 trillion. And so, again, we're going to see a step change function. We're in the process, and I like to call it price discovery. A good friend mentioned that. I was like, he's dead right. That's what it is.
Well, even if you're worried that we won't hit the new highs right away, it begs the question, where do you think Bitcoin is a year from now?
Much higher. Listen, how do you put yardsticks around something? Right? We know gold is a $12 trillion asset. Bitcoin's about a tenth of gold. Could Bitcoin be half of gold? At one point, sure it could. It will be. And at one point, it will be larger than gold, right? Again, for every Charlie Munger, God rest his soul, who passes away, that money is finding its way into Gen Z and millennials. And they feel much more comfortable with digital gold than old clunky gold. I'm kind of halfway in between. I like a little of both. I got some gold coins that we give out on our podcast. Because it's, you can touch it, but I go to a lot more Bitcoin than I do gold.
So what does this mean for the new people getting in? Do you worry at all at this point that a lot of these retail investors in particular are buying at highs?
Listen, in every mania, in every excitement, people are going to buy at the wrong level because it feels easy. And then they're going to get washed out and they're going to sell at the wrong level. And then it's going to go back up and they're going to say, I can't believe I sold. Like that's just part of speculation, and it's part of investing. You could say the same with Nvidia or Tesla or anything that, has monster moves. Everyone has FOMO. And so, yes, some investors are going to buy at the wrong level and then stop out at the wrong level. What has been unbelievably impressive about the core Bitcoin community is just how resilient they've been. Down, I remember doing an interview with you a year ago, at 18,000. And the core Bitcoiners just took pain. And so I don't think the core group of people that have owned this thing and really loved it and promoted it, there are no sellers there. Michael Saylor ain't selling. And the, new people are going to kind of ease in. Listen, I don't think you're buying it into your 401k and selling it a month later, right? And so most of this new money, I think, is going to be sticky money or hodler money in crypto terms. But the retail, the young speculation that's happening on, all the apps and on Robinhood and on Coinbase and everywhere else, that's going to have blow off tops and blow off bottoms, and people are going to get chopped up like they always do in speculative manias.
Listen, if you think about what's happening right now as well, you have to wonder with the halving around the corner here, how much is already priced in?
Again, Paul Tudor Jones taught me like year 3 of my Wall Street career, prices are set at the margin. When we have more marginal buyers than marginal sellers, prices go up. And that's what I mean by price discovery. There's a new army of buyers. There's an army of salespeople. I mean, what BlackRock is doing is breathtaking, right? That's an army of salespeople being endorsed by their CEOs saying, guys, this is an important part of the future. We didn't have that 6 months ago. And so I do think it's going to be hard to figure out where equilibrium is in the next 6 to 12 months.
So say that the demand stays constant. Of course, we've seen more demand with these Bitcoin ETFs. And you have the halving where you'll have the new coins minted daily dropping. We know that miners don't control the whole market, right? There are still a lot of large holders out there. What do you think the float really looks like right now?
But Sonali, think about it. Before the halving, with that 60,000 Bitcoin, it's about $54 million a day of new supply, right? We have one customer who is one of the retail apps that pretty much buys $30 to $35 million a day just with us. And I'm sure we're not the only person they buy with, right? There is a tremendous global demand for Bitcoin. And so when you see what's driving the market day to day right now is that 8 o'clock at night, all the ETFs talk about how much they bought or sold, and it was $500 million or $400 million. As long as those numbers stay positive, you're going to see some momentum in Bitcoin. The first day they go negative, people are going to sell off Bitcoin because they think, oh, the ETF funds are going to slow. And so that's kind of like the insider's way of looking at this in the short term. But that's a little myopic. Let's look each month at what the total flows into Bitcoin is from that ETF community plus other communities. After the halving, that 54 million goes to 27 million. I mean, that's a bid-ask spread right now. And so there's just not a lot of supply. This is one of the least inflationary assets or most deflationary assets there is. It's why, when you see our government spending so much money, people are drawn to this narrative.
So what do you think about certain features of the market right now? You think about liquidity out there, you think about leverage. Do you like where both of those things stand, or are any of those things out of whack?
Well, there's a tremendous amount of liquidity in the market right now, a shocking amount. I mean, I was looking at just some of the volumes of the stocks that traded. Forget the ETFs, which traded record volumes yesterday, but look at MicroStrategy's volume yesterday, or Marathon, or Riot's. The U.S. equity market has monster volume in crypto. You're starting to see it on the exchanges, and the crypto exchanges. And so plenty of liquidity, which means that lots of people are getting leveraged. I think the market is too leveraged right now. It happens after huge runs. You have leverage at the max, at the highs. There will be a washout. I don't know when it is, today, tomorrow, 2 weeks, a month. It'll be, I hate to call things healthy washouts because it never feels healthy when you lose money. And when there's a washout, the price will go down. But there will be a washout. People can't sustain this much leverage. And remember, a lot of the offshore trading platforms can give you 50, 60, 70 to 1 leverage. And so you got a lot of, millennials and Gen Z YOLOing it. And they will get, some will make money and a lot of them will get wiped out.
How do you describe the difference now, Mike, between the leverage you're seeing in the system versus what you saw in 2021 that caused a lot of levered players to go bankrupt?
Well, I think the big institutional players have less leverage, right? I mean, very few people are buying an ETF with leverage. And the broker-dealer community or the kind of core players, I think, learned a lot of lessons. And so I always said, we don't take a lot of leverage. Why would you take a lot of leverage on an 80 vol asset? In some ways, it's the definition of insanity to lever up an 80 vol asset. But retail still loves leverage, and you're going to see this boom bust in the short run, with an overall really positive trend as people just keep deciding to allocate some of their portfolio to Bitcoin.
Do you think it's a bad idea for there to be levered Bitcoin ETFs on that note?
No, I don't. I think, the libertarian side of me says, a 2 to 1 levered ETF, people are big boys and they know what they're doing, right? We've got products all over the place. I don't want to be telling people, how much to bet or where they should bet. If I see someone betting 15 to 1 on something that's as volatile as Bitcoin, I'll tell them, I think you need to go to your shrink here. That's just a recipe for disaster. But I think, small amounts of leverage in anything is fine.
Given the run-up we've seen in Bitcoin in and of itself, what do you think about the crypto assets outside of Bitcoin, particularly with the interest you're seeing around Ethereum and the prospect of an Ethereum ETF?
Yeah, I think that's the next big question for the community. Will Ethereum ETF get through? I know it doesn't feel like the SEC is making it easy. Are we, the same logic that the Bitcoin ETF got through on, which was there's already a futures ETF. If you believed in that, how dare you not believe in a cash ETF? Holds for Ethereum. And so my bias is it gets through sometime this year, but we'll see. Gary Gensler has been very careful about not declaring Ethereum a security. And you can have your own idea why. I'm sorry, not declaring Ethereum not a security. And you can have your own hypothesis why or why not. I would say it opens the gate if one proof of stake, crypto protocol like Ethereum is not a security. Well, what about the next one and the next one and the next one? And so all of a sudden, his argument that these are all securities would probably go out the window. And so I'm sure there's a lot of internal to and fro around this question. But the reality is we already have an Ethereum futures ETF, and that was the logic that got the Bitcoin ETF approved. And so my bias is it happens.
What about you? Is Galaxy Digital going to go public in the United States this year?
You could call the SEC and ask them when they're going to accelerate the group of companies that have been trying. Listen, we have had a very regulatory unfriendly regime of the last 4 years. We're seeing some thawing of that in DC. I don't think it really thaws until after the election. And I don't even think if the Republicans win the election, it will thaw fast. But I think if the Democrats re-win the presidency, I think you're going to see turnover pretty quick. My sense of the congressmen and senators in DC is they know we need to do something. And, it's not politically the right time, but I think it'll happen as soon as we get a fresh start.
Now, how do you see other crypto-related stocks, particularly the exchange? If you think about Coinbase, right? You think about yesterday, and a lot of people talking about how you can still trade ETFs, but there was some trouble trading on Coinbase for some users yesterday. Does that impact the exchange business?
It's a good news, bad news. They were so busy, they had so much business that the circuit breakers went off, and so. Listen, I'm sure Brian Armstrong is a very, smart guy, and they've got a huge engineering team, and they are probably working really hard. That doesn't happen again. But it just tells you the they are in pole position in this country and in this market. And listen, if I'm candid, it's been un-American and unfair that some companies got through under the Jay Clayton regime and are able to access the capital markets, and a score of others, including us, did not. They traded higher multiples, they trade with great volume, and so it's a big advantage being a U.S. publicly listed company.
Do you worry about missing the boat, though, here? Because you do see the ETFs now. So why would somebody buy into a crypto-related stock when you can just buy into crypto?
Because we do a lot of different things. Galaxy's got an asset management business. We have that literally went from, a small asset management business. We've added $4 billion in AUM in the last 2 months. We're now over $8 billion in AUM. We've got a sales and trading and derivative business that's booming. We've got our own mining business that's having an amazing run. And so when I look, we're very diversified, and it feels really good right now. It didn't feel really good a year ago, right? It was a survival and chase loose balls environment. And now it's, hire more people and keep building. Tokenization is coming. Will it happen this year or will it happen the following year? My guess is it starts this year. That will be the next big thing in crypto. And so this transition, it didn't happen as fast as we all thought it might, right back in 2017. But we are moving towards a tokenized world. We're moving towards a more digital world. And you're going to see more decentralized systems, and not supplant centralized systems, but integrate with them. And so this is not a 2-year sprint. It is a 10-year, forced march. But this idea of, crypto pipes and transparency and identity being digital, computers, when you think about AI computers talking to each other, they're going to talk to themselves in a digital currency, in a digital language. And so stable coins is going to be bigger and bigger. And Galaxy's trying to be part of that whole ecosystem. And so I think it's a very different play. Listen, all the crypto stocks right now are correlated with Bitcoin because we're so early in the cycle. But in the long run, I think you'll see big differentiation.
Hey, Mike, we're getting some questions from viewers as well. And, the question I'm getting is similar to what I was thinking myself. If the narrative around Bitcoin before was an inflation hedge, or then it became a store of value, and now we're being asked if Bitcoin is not used for commerce, what is its purpose? What's the narrative about Bitcoin? I
think it's always been the same. In some ways, it's a report card on fiscal prudence. It is a store of value. You can, it's a debasement of currency, a hedge. And so I say this all the time, a house in America in 2011 cost $190,000. Today it's $400,000. That's the median house, right? So we have debased our currency. We've had asset inflation. At times we've had goods inflation. When you're printing as much money as we're printing, when we have constant now 5-6% of budget deficits, hard assets go up, and Bitcoin is a hard asset for the new generation. It is digital gold. And if you just keep on digital gold, this is why people are buying it. And that narrative is powerful. What would change that narrative, that adoption narrative? Well, we have a new president that probably not Biden or Trump, and he gets Congress to pass a balanced budget amendment or a Simpson-Bowles amendment, and we start trying to take that 130% of debt to GDP back to 80. Right now, it's headed to 250. And so that is literally the ad. If you just look at the graph of debt to GDP in America and many other countries, and that is the advertisement for why people buy Bitcoin.
Hey, before we let you go, Mike, quickly here, what are your favorite trades right now?
Listen, it's like I said, it's been a great run. And so trees don't grow to the sky. The hardest part of managing risk is knowing when to take a few chips off and when to put them back on. And so, listen, we're really long this space. We're using this uptick to hire more people, to look at how to build Galaxy, for the future. So I guess being long my own stock is my favorite trade.
Galaxy Digital founder and CEO Mike Novogratz, we thank you so much for joining us thousands of dollars away from a fresh high in Bitcoin. Now, coming up next, we're going to talk about a down story. Snowflake stock is melting after a surprise exit from the company's CEO, a very highly watched CEO, and a weak outlook. We're going to take a look at that stock next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonali Basak. It's time now for the stock of the hour. Snowflake falling by the most ever after the software maker delivered a disappointing sales forecast and announcing the CEO exiting. For more, we're joined by Bloomberg's Brody Ford. Let's start with this issue of Frank Slootman leaving and the vice president of AI here, Sridhar Ramaswamy, taking over. What is the significance of Slootman stepping down, and why is it happening at this point, Brody?
Yeah, Frank Slootman is one of the most famous software CEOs of all time. I mean, he is a tough guy. I mean, he says things like the CEO has to be insanely confrontational. He's known as just a very hard-charging sales leader that's taken 3 companies public, just a very influential figure in the software community. But he felt that it was his time, or someone else felt that it was his time to go because they needed to really double down on AI products. As I mentioned, he's seen as this kind of sales leader. His replacement, Sridhar, is much more of a kind of product visionary. You know, he was known for making Google's search product go from 1 billion to 100 billion. He left that to start an AI search engine, got acquired by Snowflake. Clear at this point, that was an acqui-hire. So this is being read as Snowflake needing to double down on its product line to kind of be able to evolve for the AI world.
Well, can they sell themselves as an AI competitor here where AI money is going to so many rivals?
It's a great question because every software maker says that AI is going to benefit us, they need us. It can't be true for all of them, right? Snowflake's argument is that there's no AI strategy without a data strategy, so they're going to help you organize all your data and get it in a format where it's ready for large language model use. The jury is out on whether investors are buying this vision, as we see in the share price reaction today.
What about the existing path that you're looking at, Brody? We have a minute left here, and the idea here that businesses might be spending less in this environment on software. How long is that going to be a problem?
Yeah, there's this big question of, as companies spend more on AI tools, is that net new spending, or is that coming from kind of applications and traditional vendors like Snowflake? I mean, Snowflake is interesting too because when it first came out, there was a notion that it was this very novel product, but over time, the big software companies like AWS, like Microsoft Azure, have kind of increasingly offered services that do similar things. So there is an increasing competitive concern. So yes, it is unclear whether they will be able to grab the wallet share in this competitive market for, hey, it's time to organize your data.
Thanks to Bloomberg's Brody Ford. Snowflake shares down the most ever, down about 19% on the day here after a large announcement. Of course, Slootman, a very popular CEO in the technology world. Quick check on the markets here. Before we let you go, we are still looking at an S&P roughly flat on the day here, up a little more than before, 0.2% higher. That NASDAQ now up 0.5%, almost 0.6. We'll keep an eye on these markets for you. Keep an eye on us through the close. I'm Sonali Basak, and that does it for Bloomberg Markets. This is Bloomberg.